Welcome. We're going to have fun. It's going to be a very open, obviously, so if you guys don't talk, we'll be done in about an hour and a half. The last time we did this presentation, we took the full 3 hours, and I'm going to go over how we go about valuing a company. I'm going to change it up a little bit from the last time, and I'm going to give you a financial statement, and I want you guys to think about as if you was buying the company. And then at the same time, turn it around in your mind and think about your own company while we're going through it. So we'll get to the story and objective in a minute. A little bit about me. My name's Jerry Lammers. We have a company, Innovative Business Advisors. So we help people. We do basically three things. We do M&A. We help people buy and sell companies. Like to deal with companies in the that have a value between 1 and 15 million. I'm a CVA, which stands for Certified Valuation Analyst. It's a national designation to value companies. So we do a lot of business valuations. And then we do some consulting using the Value Builder system. We'll talk about that as we go through the presentation. And we also play intermediary quite a bit, where you want to sell your company, you want to buy this company. So we have the buyer and seller identified, but we have no idea how to get through the process. So we help ask all those awkward questions and stuff like that. So the plan for today is 3 parts basically. We're going to go through how to get to a true cash flow company and in the process of valuing the company, and get a little bit into the value builder stuff and non-financial things that can affect the value of the company. And then we're going to play a little game using these fun little balls up here that revolves around cash flow, which is very important because you think of a company, you've got the operating side of the company, but then you get the cash rolling through it, you know. And I could write you several ways where if you run out of cash, you may have a profitable company, but if you run out of cash, you're done, right? So a little bit about myself, my history. I grew up in a family oil company, so we sold wholesale fuel and lubricants, gasoline, diesel fuel, lubricants to shops exactly like yours. So our customers were farmers, excavators, trucking companies, manufacturing, stuff like that. Grew up in the company, came back to it in 1991. I jokingly tell people when I came back, it was me, my mom and dad, and we had 2 trucks, and it was a good day if they both started. So the reason I came back was we had the opportunity to buy another company, and I knew that would put us back into black. I was kind of the finance guy. So I came back in 1991, and our first year of sales was like $750,000, and I had the opportunity to buy 11 different companies in 18 years, and grew the company to about $42 million a year in sales. And we covered most of southern Illinois and St. Louis metropolitan area. And then Growmark is an agronomy company, but they're a co-op. It was a $6 billion corporation. So Growmark brought my lubricants into the business. I had trademarked my own brand of lubricants. We sold Schaefer lubricants, Mobile, and then I had my private label brand. So what I didn't know, and we'll talk about strategic acquisitions a little bit, is that purchasing me was a very strategic acquisition for Growmark. They had just bought a lubricants blending plant in Council Bluffs, Iowa. Growmark is a national company, but they're primarily in Illinois, Iowa, Wisconsin, and Canada. And they wanted to get into the bulk oil business in that area where they had 0 gallons. So by purchasing me, I had over 500,000 gallons in lubricant sales. So in a packaging warehouse, 50,000 gallons of storage and stuff like that. So by purchasing me, they were solidly in the lubricants business in southern Illinois. So I didn't know that until after the sale. So Growmark bought my lubricant side, and then 8 of their FS member companies. I don't know if you guys are familiar with co-ops or you have them in your areas, but you know they kind of operate by county. So 8 of their member companies bought my fuel side. So it was an interesting acquisition because technically the company got sold to 9 different people, or 9 different companies. So that's how I got into it. I had worked for them for 6 months. After that, I was done, and I had no idea what I was going to do with the rest of my life. 3 months later, my wife said, I know one thing, you're getting a job. I've discovered real quickly that our house is a marital asset that I'm not allowed to be at during the day. So I did commercial banking for 3.5 years, which was really cool because I say it's painful, but it was a great experience because you learned what banks are thinking on the other side of the fence. With my company, we had a $4 million line of credit. My accounts receivable is about $3 million, $1 million worth of inventory. So let me tell you, when it comes to cash flow, trust me, I know all about this stuff. We have about $250,000 a day in sales. So it was really neat learning the banking side of things. After working there for 3.5 years and kind of getting my entrepreneurial spirit back, discovered in life I really like mergers and acquisitions. So that's when we started Innovative, and I told you what we do with there. Recently, I've written a book about my experiences with buying companies and building your team. So I got a section in the slide. We'll talk a little bit about that too. But we'll go through some cool information. So it's no holds bars. Ask anything you want. This is meant to be very open. The stuff that we're going to talk about, a lot of people scratch their head and it's like, so I'm telling you something and it ain't clicking. Speak up. I want to see heads nodding that you get it. Make sense? Okay. Let's see if the phone will here. So I told you about what we do. Represent companies that want to buy and sell, business valuations, consulting. So valuing a business, how do I value my business? Is it an art or a science? And then we're going to go through, I think it's a little bit of both. There is some technical stuff to it, especially when we get to the value builder side. And the non-financial things, there's a lot of things to weigh out. So today's objective is to give you a reasonable understanding of how to value a business. I want you to be able to walk out of here, and if somebody gave you a set of financial statements, you could say, I think this is where it's going to be in the ballpark. And then to give you an idea of the non-financial things to look for if you want to acquire a business. I will tell you, due diligence is very important when you're going through to buy a company, and if you don't ask the right questions, they're not going to offer stuff up. So, and then, like I said, I want you to kind of turn around as we're going through this exercise and really take a hard look at your company and say, wow, if somebody wanted to buy my company, do I have a sellable company? So today's story, I want you to assume that you guys are all business owners, right? And so I want you to, this will play into the story a little bit. I want you to assume that you own 2 diesel repair shops 30 miles apart, and you've learned that acquisitions, I'm reading this to you, is a great way to expand. One of the things to think about, technicians are hard to get and stuff like that. If you buy another shop, you get their people, not only you buy in that cash flow, but you're acquiring those employees. So, there's always that asterisk when you're doing something, right? So I'm going to tell you, we're going to go through and look at a way to value a company, but the asterisk is the definition of fair market value, which is basically your company is worth what somebody's willing to pay for it and what you're willing to sell it. And at the end of the day, that's what it boils down to, but we're going to try and get you a fair way. Does that make sense? So the first step in valuing a company, start with the financial statements. And I'll tell you that if you was a coaching client of mine, I do this all the time, people come to me all the time and talk about their sales. It's not about sales, and it's not about net income. It's about gross profit and cash flow. So I want to show you a way we want to get to the true cash flow of the company. So normalizing the financial statements, what that means is we're going to go through and take out all the personal expenses that you may be running through your company, depreciation and amortization or non-cash expenses that do get added back into net income. And then we're going to normalize salaries. So if we deem a normal salary to be $100,000 a year and you're paying yourself $300,000 a year, we may add $200,000 back to the cash flow of that company. If we look at the income statement and there's no salary for you in there, we may end up pulling another $100,000 out of cash flow, because you have to assume if you're gonna buy this company, you're gonna pay yourself, right? And even on the banking side, you can't go to the bank and say, you know, well, I'm just not gonna pay myself for the first couple of years until this thing takes off. Most of the banks out there will put some type of living salary expense to take it out of there. So rent is always another big thing to look at. If you know that there's a fair market rent being charged in the financial statements, so that'll be part of our process here. So, okay, here's where we'll get into this. I'm going to give you guys an income statement because I know that's a little bit harder to read up there. Oops, start off that scene. There you go.
Thanks.
There you go. So, you know, first part of buying a company is you're going to ask for 3 to 5 years worth of financial statements. So to stick with our story, you've got 3 opportunities in front of you. And at first blush, you know, I tried to make it simple on the top. You know, they all got $1 million, we're going to say $1 million in sales, $300,000 cost of goods sold. They're all churning out about $700,000 profit, but they have different expenses. So one's making $328,000 a year. Hey, look at there, we even have a laser. One's breaking even, and one's losing $141,000 a year. So at first blush, which company looks most attractive? The one that's showing an income, right? Okay, so now I want you to take a little bit of time and go through these expenses and think about those add backs we talked about, and you know, make an X or a circle or whatever, and I'll give you a couple minutes and then let's talk about that. And while you're doing that, I'm going to warm up my coffee. That's right. Any questions?
I'm just gonna do all these.
Yeah, TV, yeah. You have any questions? You cheated. Hey, and trust me, I get it. My eyes are either getting worse or my arms are getting too short. You know? Okay, you finding anything?
There's some big differences.
Mm-hmm. Steve should like this. This is a friend of mine from Dallas. He has a company very similar to ours, so he's sitting in. So Steve does this every day too, and he's a CPA. So he's supposed to be a really smart guy.
The other wages, that's employee wages. So,
Yeah. Yep.
Yep.
So there ain't too much you can do with that.
Yep.
It is what, you know, I mean, most of these expenses are what they are.
Right.
So, so let's look at the add backs that I came up with. So what we want to do is we're going to add back, so officers' wages or what you pay yourself. So we want to get to seller's discretionary earnings. So that means, think of it this way, that is all of the earnings of the company that the seller has the discretion of spending. Whether you're spending it on yourself, paying yourself a salary, whether you're paying debt, whether you're paying lake house supplies or whatever, okay? So we want to get the seller's discretionary earnings. So if we add back officer salaries, amortization is a non-cash expense. And this is, amortization and depreciation are non-cash expenses, and you do add those back. That was probably one of the more interesting things to find out from coming from the oil company and going banking, because I was always told that by people like me, you know, sitting in your seat saying, no, you add back depreciation and amortization. Well, that was always a big number, right? And you're like, well, do they really look at that? Do they really add it back? Yes, they do. I mean, they really do. So we added back that. We had to have lake house supplies, officer's retirement plan. You want to add back things that the new owner wouldn't incur that expense, right? If they was to buy the company. Family cell phones is always a squishy one. I don't like that as an add back, because you can't knock it down to a solid number. I can't give you a bill and say this is, you know, this is what we spent on cell phones. I don't like add backs when people are telling me, you know, our cell phone bills are on $9,000, but you know, maybe half of it is the family. Yeah, I don't like that. So we all have that, and guess what? Seller's discretionary earnings for every company is $400,000. So if we determine that a fair market salary is $100,000, then we have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. You'll hear that term a lot, EBITDA, and that's really the true cash flow of the company. So, well, obviously I did this on purpose, but you know, at first blush, if you're looking at the net income of the company, we had some really crazy differences. And at the end of the day, when we get to the true cash flow, they're all three the same. So I often have people come to me, and they're kind of holding their head down, you know, because they're, you know, showing your financial statements is, you know, you don't like to do that, right? So they come to you and they're kind of got their head down because maybe it doesn't show much net income, but they may have $250,000 of depreciation. Well, here we go. Yeah, they may have $250,000 of depreciation that gets added back, and that, you know, that makes a big difference in the end number. So, okay, does this make sense?
Yes.
So,
I've got a question. What about a buyer is looking at the company, and maybe it's you got owner dependency issues, and the owner's wearing all these hats, and a buyer realistically may look at, we need to hire the sales manager, and maybe we need to hire a bookkeeper as an example. Would you do something with that as well?
yep, and we're going to get into that.
Okay.
You're jumping ahead. Yeah. Yes, he's exactly right, and we will take a look at that. So one of the things that I tell people all the time, so what Steve's talking about is getting more into the strategics of valuing a company if you want to buy it. So what I tell people, and I can do that in evaluation. In fact, the valuation I'm going to show you, we did some of that, just to the point that Steve was saying, the owner did everything. So we took away from cash flow that we might hire a couple of other employees. But for the most part, when I'm valuing a company, I'm looking at it from a financial perspective. Does this financially make sense to buy this company versus what a strategic factor may be? And we'll talk a little about that. So that adds, at least perfectly, to the next couple of slides. How do we come up with a value? So now we know the true cash flow of the company. There's three approaches to valuing a company. There's the income approach, which is most often used. We're going to value the cash flow of that company. There's a market approach, and think of the market approach is most commonly used in real estate. So if I have a house, it's 3 bedrooms, you know, 2-car garage, 1,500 square foot, and it's worth $150,000, and there's one exactly like it across the street, it's probably worth $150,000, right? So the market approach for businesses is a little tougher because every business is unique. Although we use the market approach as kind of a sanity check. So there's companies I can go out to and get information from, and we'll show you some of that too later. Rule of thumb data. So especially like a dentist company, you know, they'll say, you know, it'll sell for X number times sales or X number times EBITDA, stuff like that. So we do use that. The asset approach is most commonly used whenever the company's failed or it's not making money. Now, you know, we're just valuing what's the fair market value of the assets. That's pretty much the asset approach. So one of the things, so we most often use the income approach in a very common method. So then there's methods under each approach, and I want to talk to you about a discounted cash flow method. So if you buy a company, you want a certain rate of return, right? If you didn't want to own a small business, you can invest your money in a money market, but you're only going to get, say, 2.5%, 3-4%. So what rate of return should you get for taking on the risk of owning this smaller company? For me, when I was buying other oil companies, if I could pay for the company in 3 to 5 years, that was a trigger for me to want to buy that company. So if I'm buying the company and I'm paying for it in 3 years, I'm getting a rate of return of 33%. 4 years would be 25, and 5 years would be 20%. So if you take our cash flow of $300,000 and divide it by that rate of return, you'll come up with a value. So 300,000 divided by 20% would be $1.5 million. By 25 would be 1.2, and then by 33%, $909,000. So, all right, where are we at, and how do we know when, which one is it? Is it the 909 or is it $1.5 million? Well, one of the things that I hang my hat on a lot in doing these valuations is a bankable deal. If I say the company's worth $1.2 million, can you go to the bank and put a reasonable down payment and have enough cash flow to make the payments on the remaining amount? Make sense? So we have this deal we call the buyer's method, or often call it the banker's method, and we're going to play it. Hopefully the computer will cooperate with me and we'll play around with it for a little bit. So if I say an estimated sales price is $950,000 and I'm going to pay myself a reasonable salary of $100,000, we're going to put 20% down. That would leave us $190,000 down payment, it'll leave us with a $760,000 loan. I used an interest rate of 5%, which is a little generous today, and paying it off in 5 years. Is that too small? Can you guys see those numbers? Too small. Too small? I'm going to try and make that a little bit bigger.
But we can all move to the front.
What's that?
We can just move to the front.
It's not letting me do that. I'll explain it. So we start off with seller's discretionary earnings of $400,000. My finger ain't working. We're paying ourselves $100,000 a year, so we got $300,000 in cash flow to service the debt. In this scenario, your annual debt payments would be $172,000 a year, which leaves you with $127,000 extra. But what I really want you to focus on is this debt service coverage ratio of 1.74. So what that means is there's $1.74 in income for every dollar's worth of debt. Most banks want to see a minimum debt service coverage ratio of 1.2 to 1.25. But I'll tell you, that's a very leveraged number. Like that's going to be tight to make. When you start getting the 1.7, 1.8, that's a comfortable number, and everybody will like that number. So at $950, an estimated selling price at $950,000, it gives you a debt service coverage. You can pay yourself $100,000 a year, and it gives you a debt service coverage ratio of 1.74. Any banker will go for that deal, guaranteed. And then that gives you a rate of return of 31.58, which means you technically would be paying for, if you didn't have interest in other things, you'd technically be paying for that company in a little less than 3 years. So, I can show you if this will work. It looks like it is. So say the person wants to sell the company for that $1.5 million. Well, you can see at $1.5 million, look what happens to our debt service coverage ratio. It drops to 1.1. Well, a bank's not going to approve that. So it's a pretty easy argument, if you're looking at buying a company from a financial perspective, that this ain't going to work. There's barely enough cash flow to do it, and a banker isn't going to approve that loan. Likewise, if you're thinking, I don't know, 5 years. You know, if I'm looking at valuing this and I say the company's worth $500,000, well, as a valuator, I'm looking at that debt service coverage ratio and going, wow, you know, that's a deal. We got $3.30 for every dollar's worth of debt. You know, yeah, we'll take that. No, any day. And you're getting a 60% return on your money. So, you know, it's kind of playing around with the number. And all of a sudden, that $950,000, that looks like we're in the ballpark. Does that make sense?
No water.
Don't do that. That's really kind of tight for a big old loan.
Hey, Terry,
Yes, sir.
and what happens if like that, the loan period is 5, what if you're gonna pay that back in 3 years? What would that happen to the debt service coverage?
So that's a good point. So let's look at that in two different ways. Ooh. Huh. My computer's saying you already did this one, so I'm not doing it again. Well, so what's going to happen is, obviously, your debt service is going to go up, right? So correspondingly, your debt service coverage ratio is going to go down. So if you want to pay for it, you've got extra money here. So we'll get back to that. So what I want to tell you, here's what I want to tell you. In a normal banking situation, non-SBA, a bank isn't going to want to go much further than 3 to 5 years. Some will go 7, but 5 is a good norm of what they'll want to give you for an amortization period, how long you pay that back, for normal buying equipment and goodwill of the company. So if there's a lot of goodwill in the company, say of this $950,000 purchase price, there's $500,000 in goodwill. Every loan, you know, the basics of any loan is collateral and cash flow. So if you don't have the collateral to support the $950,000, because there's $500,000 of goodwill, a normal way to do things is to go get an SBA loan. That's what the SBA is for, Small Business Administration. They will guarantee 80% of this loan, which gives you the collateral that the bank wants. And here's the key. They'll give you a 10-year amortization schedule. So what's that do to your debt payments? It drops them significantly. But here's where the red flag comes in. I wish my computer was cooperating with me. If we went back up to that $1.5 million and we had a 1.1 debt service coverage ratio, if we change this to 10 years, I'll bet you we're going to have close to 2, 1.8. So what happens with a lot of bankers, and this is how I term it, they will sell you a loan. You know, this works great. You know, we'll give you a 10-year amortization schedule and you've got $1.5 million to go buy this business. But you overpaid for it. You know, so think about it. Do you really want to be paying for that company in the next 10 years? You know, because after year 5, equipment's going to start wearing out. You're going to need to replace things. And you're still making a freaking debt payments on this thing. And I see it all the time. And sadly enough, I see it where dad sold the company to the kids. And now the kids are strapped with it. You know, because they overpriced it. So, so I was a small guy buying companies, and I told you, you know, if I could pay for it in 3 to 5 years, that was a trigger. and this is where strategic acquisition, there's no one way to look at this. So I got done selling my company to Growmart. Growmart's a $6 billion company. They have an acquisitions department. That's all they do is buy stuff, you know. So I got to know them fairly well. It was a good company to deal with. And when we was done, I said, okay, what's your trigger point? You know, what is your number that says, hey, we like this deal? And their number is 33%. But there's 2 ways to look at this also. We are looking at the cash flow that this company's spinning off from a non-strategic standpoint. We're looking at how, you know, their cost of goods sold, their gross profit. What Growmark will do, and me and my accountant used to butt heads on this, Growmark looks at it from how the cash flow that it'll spin off as they own it. So You know, they're pipeline shippers, they blend their own lubricants, their cost of goods sold section is gonna be different. You know, if I'm selling 500,000 gallons and coming up with X number of gross profit, and they can produce that oil cheaper, they may get a bigger gross profit out of that. Likewise, Steve alluded to it, and we'll get into it further, they're gonna look at that look at your operating expenses on the financial statement I got, and there's a lot of things that they may be able to whack out of there, and it's gonna look different, so their cash flow is gonna be different with the same amount of sales than it was for me. So keep that in mind. Because again, when I'm valuing a company, I'm valuing the cash flow that the company is spinning off. My accountant and I always butted heads that you pay for a company for the cash flow that it is producing, not as it is producing under you. You know, so really that just leads you not to overpay for a company. But when Growmark was looking at my company, they do look at things, this is how we anticipate, you know, cash flow coming off this company, as long as we can make 33% off it, which pays, you know, gets them paid for in 3 years, that's a trigger.
So conventional loan is gonna require like a 20% down payment, and SBA would be 10%, right?
Mm-hmm.
So it's just interesting, just in a different percentage.
Right, it's another way from a valuation standpoint they can play with it. If you looked at a lot of my valuations, some of them this number will be at 10%, some of them it's at 20. There's little ways that you can play with the number when I'm looking at a company. And if I think it's a really strong company, I'll put a 20% down payment in there, because how does that affect the bankability of it? Well, if you're putting 20% down, you know, that's 190,000. If I was only putting 10% down, that's only 95,000. So that means you're servicing more debt, which is ultimately going to affect your debt service coverage ratio. So, and if you do an SBA loan, they only require 10% down. So, and that's why I love that first, you know, one of the first slides is an art or a science. I mean, there's a lot of ways you can monkey with these numbers. But in general, this is, you know, if you can get to where this is 1.7, 1.8, you're good. And the bank's going to go for that. Personally, when I was running my company, I wanted to be at least a 2 on my debt service coverage ratio. That made me comfortable.
Is there a spreadsheet that we could use to figure out?
Yes. I wasn't going to show it today, but I can if we got time. So what I like to do with my clients when I'm coaching them is I like to see you guys. Last time we did this, I showed it. Put your income statement into an income trend and look at a 12-month rolling average. Or Steve does his clients. Or was it you was talking about, or somebody?
Yeah, the trailing 12 months.
A rolling average. I just like to see people do it every month and put it side by side so you can see a trend. And do the same thing with your balance sheet. I do this on Excel, and then you have another worksheet where you have a ratio analysis page where I like to look at current ratio, which is current assets and compared to current liabilities, your accounts receivable days, payable days, inventory days, which we're going to play around with here, and what your created debt schedule, which I think is very important, where you list all of your debts and, you know, what was the original amount, what's the interest rate, what's the payment, when did, you know, is it a balloon, so when does it mature versus being paid off, and what did you borrow the money for? I mean, I would make the argument that there's, you know, we've all heard of bad debt, which means you can't pay it back, but within a company, I think there's good debt and bad debt. Good debt to me is money that you borrowed to buy a company or a piece of equipment or a building, you know, and the loan's still there, the debt's still there, but it's from the intended purpose of the loan. A bad debt on a balance sheet to me is you turned out a line of credit because you couldn't pay it back, or you know, you borrowed money to buy a piece of equipment, but you're not using the piece of equipment anymore because it's junk, but you still owe money on it. I mean, that's, to me, that's bad debt. So, okay, did we beat this horse to death? Good. So, what outside factors can affect the value of the company? This is what's really interesting stuff. So, let's look at, this is where the value builder system starts to come in. Mom disappeared, she got tired. There you go. So again, see a plus minus column out here? So we're gonna run through these and I'm gonna give you some kind of scenarios. And when we get to the end, I want you to tell me which company you would buy. So if the financial statements are the cornerstone of buying a company, you know, that's what we're really looking at. But then there's this other stuff that's out there that, you know, is this a good company to buy or not? So we'll go through this and kind of make some notes or whatever on the side. So growth potential. Oops, where are we at? What am I calculator doing? There we are. There's a questionnaire on our website. If you go to our website, you can take this questionnaire, Value Builder questionnaire, for free. And again, that kind of goes to flip it around to look at your own company, right? Look at your company and kind of self-analyze yourself. And it'll create an assessment, and I'll get that to you. I knew this would be a little bit small, so that's why I printed it off for you. So growth potential. What, you know, is there? Can we, if we buy this company, can we grow it? You know, what's our chances of doubling it? Or if you're getting into the business for the first time, what's the chances that we get this one going and I can go to another town or another state and do the same thing over? Okay, so company one is a shop. The shop is too small, but it's located in a town between your two shops, 30 miles apart, right? Company two. Shop is adequate size, has a long-term lease, so you're not buying the real estate. And company three uses about 75% of the building, high traffic area, 60 miles from your home in the opposite direction of the other shop. The real estate goes with it, and it's priced very fair. So think about these three situations. If you really want to grow the business, you got one shop that's too small for the business, but it's in between your other two shops. You got one shop that's adequate size and has a long-term lease. You're not buying the real estate though. So what about that lease in the future? And the other shop is got room to grow in, but it's 60 miles from your house and in the wrong direction of the other shop. That's 30 miles the other way. Okay. Switzerland structure. So what we're talking about with the Switzerland structure is your business or this business that you're buying overly dependent on any one customer, any one supplier, or any one employee? And that can make a big difference if you're selling a company, right? And I'll kind of come up with an example. So to talk about the three companies, in the Switzerland structure, company number one, 60% of the business comes from one customer. Is that a good thing? Company number two, 2 of the 5 techs are 60 plus years old and don't want to take any new training. Does that make you think? And company number 3, long-term contract and all lube equipment with mobile, so 100. There's 6 years left on the contract. The contract has to be transferred with the business, so 100% of your lubes have to come from mobile, have to come from one supplier. You can't change that. Make sense? Or, I mean, you see where we're going with the Switzerland structure if you're overly dependent on one thing? The valuation teeter-totter, that's where we're going to work with this a little later. But think about when you're buying a company, you're in essence writing 2 checks. You're writing one check for the company, but then there's another check or money that you have to absorb in the working capital. So, you know, how fast is this company, what's it going to take to run it? You know, if they have $500,000 in accounts receivable, and it takes, you're going to have to absorb that. You know, if there's $100,000 worth of inventory, and that's just what you have to have, you're going to have to absorb that. So technically, that's like another $600,000 that you need to have to purchase this company. And what they're saying about the valuation teeter-totter is if your company has a lot of working capital requirements, it could have downward pressure on the price of the company. You know, with mine, with $3 million in accounts receivable and $1 million worth of inventory, whoever bought my company theoretically is coming with another check for $4 million. I mean, that's significant. So, so we had the three ways there. Or, well, okay, on the valuation teeter-totter, let's say for company one, they factor 100% of their receivables. Clients have 5 days to pay their factoring fee, and the factoring fee, you guys understand how factoring works, right? You're basically selling your receivables, and there's a fee that goes along with it. So let's assume that's 3%. Company number two does no factoring, and their average accounts receivable days are 60 to 90 days. And company number three factors slow-paying customers. Other customers pay cash at pickup. So another thing to think about, you know, especially if you have your own shop, it's like, well, I'm going to change that. Well, yeah, when you're buying a company, making changes on how people are going to pay right out of the gate can be very detrimental. So what I want you to think about is, say you're like company number two, and this guy, the previous owner, was sloppy on his accounts receivable, and he's letting them customers go out there 90 days before they pay, and you know that's not acceptable. But if you go to that customer and say, hey, starting today, Buster Bob, you're paying in 30 days, or you can take your crap down the road. Well, that might severely affect you know, your sales. That you borrowed money to buy this thing, so you don't want to run them off. Trust me, I've been in that situation 1,000 times, it seems like. You buy the company, they've given him sloppy terms, letting him pay too long. You try and rein him in, and he quits. Then he goes down the road to the next guy, and guess what? He's still got to pay in 30 days because he's not going to get those sloppy terms, but he's not going to do it with you because you was the bad guy that originally told him that he's got to pay better. So, again, do you see the theme of non-financial things that can affect the value of the company? Recurring revenue. This is a big one. I can guarantee you companies with recurring revenue fetch a higher price than companies that don't. So what I mean by recurring revenue is, you know, they got to come back to you. You guys have an element of recurring revenue in your business, in the fact that if you own a truck, you're going to have to work on it, right? You know, you have to have annual inspections. So how can you develop within your company ways that trigger them to automatically come back to you? That's a good thing to be thinking about. So with our three companies, company one does annual PMs for all customers with an average ticket of $1,500, and they got 400 clients that they do this with. Company number two, two local trucking companies with 10 trucks that they do all of their work for. The rest of the customers come and go. And company number three, the high traffic one, is mostly interstate traffic. So they're just grabbing people off the interstate. Okay? Monopoly structure. So what this is referring to is, is your company selling something that you get to put the price on? You know, you're not getting out. So look at gas stations are a perfect example of this. I mean, who's the knucklehead that came up with the idea that you have to put your price out on the street? Because what do people do? It's like, well, this guy's $2.12 and this guy's $2.10. I'm going to go over here, right? I mean, you guys get the same thing with your shops. I mean, that kind of floored me when I started coaching you guys, because I had a fleet of trucks. I jokingly said that, you know, we was a trucking company that delivered oil more than we was an oil company and had trucks, you know. I had 15 of these things running around. And my thing with my trucks was, I want them on the road. I don't care if you charge $100 an hour and you charge $150 an hour, but maybe it takes you 5 hours to do what he can do in 3 hours. The main thing is, I want it there and I want it back out, you know. But I know you get pressure, what's your shop rate, right? So that's what we're talking about with monopoly control. Are you doing something that's unique that you can charge the price that you want on it? So company number one, only shop in town, no pressure on shop rates from other competitors. Company number two has to match a shop rate of a competitor that's 30 miles away. And company number three, 4 other shops within 10 miles, constant war on rates. We'll move on to customer satisfaction. this one seems a little squishy to me, but at the same time, it kind of makes sense, especially in today's social media world. Are you surveying your customers? And the whole idea is there's such a thing, it's called a net promoter score, which I'm not going to get into, but it basically is your customers promoting your business? Are you doing, do you conditioning them that they're going to the next guy and say, hey, get your truck taken care of here, these guys are really taking care of you. Or, especially in today's world with Google and everything else, do you have people on social media lambasting you and, the company's got a bad reputation. So company number one, he doesn't know. He didn't talk to his customers. He don't know what his customer satisfaction is. Company number two, most of his new customers come by word of mouth. So he's probably got a pretty good reputation out there. Customer number three, ask for reviews on social media, 5-star rating on most sites. So, we'll do it. The last one, hub and spoke. This is another really important one. What the hub and spoke is referring to is you're the owner, you're the hub. Your customers, suppliers, and everything else is the spokes. So in your business, or in the business you're looking to buy, what's the owner doing? Do all the customers come to him? Does he do all the work? Does he direct all the suppliers? If you take him out of that situation, what's going to happen to the company, right? So if we look at our three companies again, the first one, owner performs 30% of the work, everybody loves him. So he's the matriarch of the company, right? Company number two, the owner leads business development, but he has a shop manager and an office manager. And company number three has monthly meetings with his managers, otherwise not seen by employees or customers. So, does that make sense, what I'm talking about? I had recently, I gave up on selling a company. It was a trucking company, had $500,000 a year in cash flow, so he's spending off some good cash, and that's after paying himself a fair salary, but he was it. He was trucking and logistics. He dispatched all the trucks, all the employees reported to him, and he went out and got all the new business and visited the job sites and stuff like that. Every person that looked at that company would go, this is a nice company, but if you leave, who's running this thing? And it ultimately didn't sell, even with having cash flow of $500,000 a year. Yeah, good job. If you're sticking an extra $500,000 in your pocket, but at the end of the day, he was the business. So the Switzerland structure, I had a customer, a trucking company that delivered all the milk for a dairy in town. He had 50 trucks. I have no idea what he makes. He was just a customer of mine. Went through 10,000 gallons of fuel a week, so he was a good customer. But guess how many customers he had? One, the dairy. It was his only customer. Would you buy that company? It's crazy. This hub and spoke one, I had another trucking company that was a customer of mine, same deal, ran about 50 trucks. And when I went to work for the bank, he had a relationship with the bank. His mom died, and she was the matriarch of the family. And the son does all the dispatching of the trucks. And you can't even have a conversation with him because he's answering his phone every 2 seconds. And I told him, I said, Kenny, you need to get somebody in here to dispatch those trucks. And you need to be working on the business, not in it. And he looked at me and he said, Terry, I'm the only person that can do this. I'm like, okay, all the trucking companies in the world, and you're the only one that can dispatch 50 trucks. That's a problem with that company. So that's kind of the basis of the value builder system, and then non-financial things that can really affect the value of the business. So tell me, which company would you buy?
3.
Which one?
3.
You like 3?
Maybe someone else will move closer.
There you go. So I hope that helps you kind of get a grasp of other things to look at when you're buying a company, And like I said, turn around and take a look at yourself and say, you know, someday I'm gonna wanna sell my business. Am I setting it up, am I growing it to where I have a sellable business? It really does make a difference. So here's one thing I wanna throw at you. What about the strategic value? So in the first company we talked about, it's a smaller company, shop's not big enough. It's sitting right in the middle of your two other companies that are 30 miles apart. So what's the possibility to do with that company?
Eliminate competition.
What if you close the shop down and just got the people to go to your other spots? They're only going 15 miles apart. Now, look at your financial statement. What expenses could you whack out if you was eliminating that shop? You know, look at, you know, you're still going to add back his salary. You're probably still going to keep his techs. You're still adding back amortization. Advertising, if you're looking at this from a strategic standpoint, are you really going to spend that $2,000 in advertising, or you're already advertising, right?
We're already advertising.
So, auto and truck, that's another one to think about. Let's say the auto and truck is a search truck. A parts truck that's running around. If you buy that company, you've probably already got a parts truck, right? So are you really going to have that expense? Or maybe you're going to have half of it. Contributions, people always want to add that back. I always say, it's kind of a community thing, you know. If you've been sponsoring this freaking raffle or golf tournament that you've been for 10 years, you're probably going to be required to do it too. Dues and subscriptions is another good one. You know, if you're paying to come to this conference and you buy another business, you're not going to pay twice. You know, you already belong to, for me, it was the Illinois Petroleum Marketers Association. So if I buy another company in Illinois, I don't have to pay more of a fee. So that's probably one that's going to go away for you. Employee insurance, not much you can do there. Insurance in general, that's a big one. If you eliminate a shop, well, you don't have the insurance on a shop, but all your liability limits, so if you're carrying like $3 million of liability insurance that you're paying for, if you buy another place, that doesn't increase. So for me, insurance was always a big one that came off the plate. So this company is a pretty big number that you're not going to have to pay if you buy this company. Professional fees, think about that one. You already have an accountant, right? So if you buy this company, you're probably not paying for him. It's probably not going to, you know, if it's all attorney's fees, that may be something, but accounting is a big one. License, taxes, that's probably one that's going to go away, right? Yeah, maybe you get the lake house and deal. I always laugh, so it's kind of funny. Every time I buy a company, the owner would go buy a new truck. It got to the point, it's like, I might as well negotiate the price of a truck and just buy this company, because that's the first thing everybody does. I bought a lot of new trucks for people. Utilities. It is, it's kind of funny. It's like, hey, Bob's got a new truck. Utilities and telephone, you know, again, you eliminate. So that's what I was hoping that somebody would say, you know, that's a pretty good wiggle if I can buy this company and eliminate it. So I didn't, well, probably another thing I could do, I didn't add up if we did this from a strategic acquisition standpoint of what that did $200,000 or $300,000 in cash flow. But I'm willing to bet that with us just going through that, it probably added another $100,000 to it. So that is something to think about when you're buying another company. You really need to take a look and project out. I always tell people, that's why I preach on the gross profit. You know, more than likely, that's going to probably stay pretty much the same, but what is your expenses going to look like when you're running it versus them? So I like to tell stories. Another quick story is I actually had that happen with me. I had a bulk plant in Payroll, Illinois, and Vandalia, Illinois, 30 miles apart. I had a competitor. It was an old Amico jobber in Greenville, Illinois, which is right smack dab in the middle. I had very high customer concentration rate around this area, and he was for sale. And he wanted about $100,000 too much for that company versus how it would make sense on our bankability or being able to pay for it in 3 to 5 years. But remember I said, you're paying for what the cash flow the company's spinning off. Well, this guy, in his mid-60s, one horse operation, you know, just him, almost all of his expenses are gonna disappear under me because I've already got trucks running in the same area, you know, and he's small enough, I won't have to buy another truck. So really, I'm soaking up almost 100% of that gross profit. So did I pay him $100,000 more than what I thought the company was worth? Dang tootin' I did, because I eliminated competition and I tore down the bulk plant. Nobody else is gonna have it. What I didn't want is a competitor to buy it and now have, you know, a bulk storage facility right frickin' smack dab in the middle of my main area. So I hope that gets your, what I really want you to do today is I really want you to start thinking acquisitions are a great way to grow. You know, there's certain things you need to think about when you're buying a company that doesn't necessarily have anything to do with the financial aspect of it. You know, and again, not to beat a dead horse, but to turn around and look at yourself. And, you know, sooner or later, one of these days, you're going to have to exit. So do I have a sellable company? Okay, we're getting to where we're about, got this first section wrapped up. So if you go to our website, you take the Value Builder assessment, it creates about a 23-page report. Value Builder tells us to sell it for about $700. I'll get it to you free. So, talk a little bit about the book. I'll give everybody a copy before you leave. The beginning of the book talks about buying companies and, you know, why you may want to buy an existing company versus starting a company from scratch. We get into how to value a company, just like what we did up here, and in the process of buying a company. The middle of the book, I say, is about building your team. So there's chapters on attorneys, bankers, financial advisors, CPAs. We get into bankability and how, you know, there's two parts to a loan, cash flow and collateral, and debt service coverage and global debt service coverage. We didn't really talk about that, but that's something that a bank will look at too. Not just you're buying this company, so what's the debt service coverage ratio on it? But if your personal life is a disaster and you've got tons of outstanding debt, they'll add that into it, and then, you know, that's what you call your global debt service coverage. Or if you have existing debt with your business and you're going to buy another business, what's it look like altogether? A bank, here's just a good piece of information to know. When you're buying a company, and you know these companies, you don't have contracts with 100% of your customers, so what's the bank worried about? You buy the company and the customers run away, right? So a bank will be hesitant, and this was frustrating as heck, to use the income from the company that you're buying and show that it's going to service the debt. And I, in the early years, fought that all the time. They're like, I don't know, debt service coverage ratio doesn't look good. I'm like, what are you talking about? Look at the income from the company. It supports the debt. Well, what if they quit? It's like, well, you're being a pain. But when I got later on, when I got to the point where the existing cash flow of my company could service the debt for the company that I was buying, then it became a no-brainer. And it clicked. And that's when we really picked up the pace and started buying a lot of companies. Because so make sure you understand that. The existing cash flow from your current company could support the debt of that $950,000 of the company you're buying without taking into consideration any of the income from that company. Does that make sense? So that, when you get to that point, that's when things really start clicking. And that's when, if you've got that kind of supporting cash flow, the bank's going to start turning the other cheek when it comes to collateral. Because if your collateral is a lot like mine, banks don't like it. You know, what the hell are they going to do with a tire changer? You know, and they don't, that computer, electronic stuff you got to monitor engines, if you go broke, it's probably not very marketable to somebody else. You know, I had a bunch of gas trucks and bulk points. They sure as heck didn't want that. So, cash flow is very important. This is just kind of getting into our target clients or companies that have a value of 1 to 15 million. We talked about the book. I just kind of for other people, I mean, but more than happy anybody wants a book. Books on Amazon also, you can download it for free on Kindle. That's my contact information. And that's it. So we are at 9:14. I think we're supposed to start at 8, we're supposed to go to like 11, does that make sense? Okay, you guys wanna take a short break and I'll set up this cash flow game and then we're gonna come in here and I'm gonna have a couple of you guys help me and we're gonna look at how cash moves through a company and how your accounts receivable days, accounts payable days can play with that. You guys ready?
Yeah.
Let's play my little game.
Good morning. I didn't see you.
Sorry, Dan.
No problem.
100 miles per hour.
Yeah, right, no doubt it's an endurance.
Well, that thing better turn back on later on than man. I love talking about mergers and acquisitions. We could be in here all day. Funny story. I bought a company one time. It was in the same little town. I bought 3 companies in one town. It's kind of crazy. But I was buying Greenville Service Company, and it was another smaller acquisition, and confidentiality got breached. So it was the worst kept secret in the county that I was buying this company, and it was going to happen on, the first day of the month. So my banker, the bank I was dealing with, they had a mandatory 2-week vacation that the bankers had to take, the loan officer. So theoretically, if he was cheating the company or stealing, they would show up in that 2 weeks' time. Well, I'll be if my banker goes on vacation right when this is supposed to happen. And I previously just bought a company, and while we was doing this, he's like, yeah, when this is coming up, we're going to do this, blah, blah, blah. So he goes on vacation. Then I have to talk to his boss. His boss goes, well, if we approve the loan, it called it if and when. He was like, if we approve it, we might be able to get it done, the paperwork done by the end of the month. And I'm like, oh no, this is not good. So I went to my supplier, and I needed like $250,000. So nothing that big, but at the time it was a lot of money to me. I went to my supplier and I said, hey, here's my situation. And they're like, I was a good customer for them, big customer. They're like, yeah, no problem. They was going to loan me money. So I met at their office. He makes a phone call to his bank because he's going to do the classic thing that you shouldn't do: use your line of credit, to help me buy this company. And we had it worked out. I was going to pay him back in 90 days. So anyway, I was at their office. They said, go to Bank of America, downtown St. Louis, and the guy will come out and give you a check. Have to sign some paperwork. So here I am in my big 4-wheel drive truck, and I drive downtown St. Louis, park on just off of Broadway. Dude comes running out of the 40-story Bank of America building, flops the paperwork on the hood of my truck, a couple signatures, and he hands me a check for $250,000. And the next day I bought the company, and it all worked out. So we talked about cash flow, and the cash flow that we talked about here was the cash flow that the company's producing, kind of like the net income. So net income is a bad word to me, right? We're talking about cash flow. But there's also cash that moves around inside your company, and it can make your life miserable, right? Because you got all this accounts receivable, but there's no cash in the checkbook. So this came from one of you guys, and you probably know the Connors, right? Greg and Stacy. So I'm talking to them about cash flow, and Greg's just not getting it. And finally, Stacy grabs, we're doing this by Zoom, she grabs a pile of paper clips, throws it on the desk, and says, look, this is what he's talking about. And she starts playing around with it. And all of a sudden, Greg goes, ah. So you guys are also visual. So my wheels started turning, and we created this little game. And it started out with M&Ms. And doing it with my sales team is like, don't eat the M&Ms. There's a point to this, okay? So it is a pretty neat way to kind of show how money moves through a company. So I need to know, who wants to be my revenue guy? All right? I need a accounts payable guy. I think we can cover it with 2. I think maybe last time I used it. We need another person. Okay, so you got all kinds of revenue. This is an unlimited bucket. You've got a line of credit from your bank, and I'm going to say you only get 10 balls for your line of credit. Okay? So if we had, we'll start off by selling just one ball a day. So on day one, and I gotta keep track of this because I get to talking and I forget what day we're on. So on day one, we sell a ball. So what happens? It goes in the accounts receivable bucket, right? You don't have it. So we're gonna assume, in this scenario, that you have 8 accounts receivable days. So that means from the time you sell it, it's 8 days until you get your money, right? But you have 3 accounts payable days. So whenever you buy something, you gotta pay for it in 3 days. Okay, so day one, you sold the ball, and now let's say it's day 2, you sell another ball. Am I standing in the way? I'm sorry. Yes. Okay, so it goes into your accounts receivable bucket, right? Okay, now day 3, okay, you sold another bucket now, but you have to pay a bill. Here's your checkbook. Ain't no money in it yet. So, what are you gonna do?
You wanna borrow money from me?
Can I borrow some money?
So you're gonna use, well, actually, we're gonna put it in the accounts, we're gonna put it in the accounts payable bucket, okay? But yeah, but you get the idea, to use like, you gotta use it like credit, because you don't have any cash. Okay? Now, day 4, same scenario. Okay, you got another bill to pay. Day 5, day 6, day 7.
Hey, thanks for all your cash.
Okay, now we're to day 8. So what happens on day 8? There you go. So now, do you want to use your cash, or do you want to use more line of credit? Okay, so you didn't have to use your line of credit. Okay, so now day 9 and 10, you're basically the same thing. So
2 more here,
2 more there. No, so you got cash,
1 here, and 1 there.
and then day 10 would be the same way, right?
Right.
So, okay, so here's the point. The red balls, this, think of your working capital. This is the working capital you need to run your company in this situation, right? So, okay, well, let's run it another way. Now let's say you have 3 accounts receivable days and 8 accounts payable days. So on day 1, you're gonna sell 1 ball, it goes in there. And day 2, you're gonna sell a ball, it goes in there. Day 3, you're gonna sell a ball, and you have, no, keep going. Day 4, day 5, day 6. Wait a minute, we messed up. Don't you, you're not playing the game right. I'm sorry. Okay, day 1. Day 1 it goes into accounts receivable. Okay, day 2 goes into accounts receivable. Day 3, you sold the ball, goes into accounts receivable, but you also received payment. So now, a ball from accounts receivable goes into the checkbook. Okay, so day 4,
1 in,
1 out. Day 5,
1 in,
1 out. Day 6, day 7, day 8. So now on day 8, you have the payable. So you want to use your line of credit, or you want to use cash? So you get the point? You get cash. So that is yeah. So, but that's how it got to where, so a lot of times, and a lot of you guys factor your receivables. So you can be in a positive cash flow situation, but there's an expense. I'm not a fan of factoring receivables. I totally freaking get it why you do it. I had to do it at one time myself too. But you get addicted to it. You don't ever want to quit. And at a certain point, you really need to analyze, does it make sense for me to factor my receivables or to go to the bank and get a line of credit? And I get the arguments, you know, I like my factoring because if they don't pay, they've got the collections team, they're the ones that have to hound them. You know, I get it. But I'm just telling you, at some point, if your companies get bigger, the expense of factoring needs to be looked at. All right.
We had a customer paying credit card, so the credit card charge was more than the factoring charge, so I was saving money.
People don't get, they think credit cards are free, you know. But, you know, let's run it again. And let's just say now you're selling 3 balls a day, and we're back to where you've got 8 payable days, 8 accounts receivable days and 3 payable days. So day 1, you sell your 3 balls, right?
Yep.
Day 2, you sell 3 more balls. Day 4, day 3, now we got to day 3, before we get to day 4, you've got a payable of 3, but you don't know cash. Now you're using 3 balls. So day 4, from there, you got 3 more balls. Day 5, hopefully we won't run out of balls. So, yeah, so again, so there's nothing more to this point than that the bigger you get, the bigger the problem gets, right? So now, here's an interesting way to look at it too. So let's
It's the best
start.
way to get the red balls back into that bin with the green balls.
Yeah, well, so here's what can happen too, think of it this way. Alright, so now we're back to 3 balls. And you've got 3 accounts receivable days, 8 accounts payable days. So day 1, you sell 3 balls. Day 2, you sell 3 balls. Day 3, you sell 3 balls. And 3 go into here, so you get money in your checkbook. So things are looking good. So you want to hire more people and sell more stuff, right? So you hire that salesman. Now you're selling 5 balls a day, but he picked up slower paying customers. So now we've reverted back to 8 accounts receivable days and 3 accounts payable days. You know, technically it wouldn't change your payable days, but I made the rules to get it. So, okay, on day 1, now we're going starting over, you sold 5 balls. On day 2, you sold another 5 balls. On day,
So it's the 5.
yeah, we should put,
right?
yeah. Yeah, we should, that's where our 3rd person we're missing. Okay, that's good, now, but now we switch back. Okay, now it's day 3, you got a payable, so you need 5 balls you gotta pay. Now you have money in the checkbook.
I did have money in the checking account.
You-
I like to say my
that's
money in
fine.
the checking account.
Okay, so it's the next day, now, so,
I got 30 days to pay this off.
so you got 5 more revenue balls that went into accounts receivable.
Here, and
Yep.
5 more went into here. Yeah.
No, because we switched back, you gotta go 8 days and so. So you've got another payable, you need 5 balls to, and you can use your checkbook if you want, but either which way, you gotta get 5 balls into there.
Well, we'll max out this.
Okay?
I have no more money.
Taking a partial cash?
Down, I got some in my checking account, but it's.
Okay, it's day 6.
Day 6, another 5.
Now you gotta pay,
5 of these in here.
now it's day 7.
I'm gonna take 5 of these out.
No, you can't do that. What? They're gonna punish you.
5 more?
In the accounts receivable, now you need to pay 5 balls. You've only got 3 balls left. Then you don't have nothing left on your line of credit, and now you're out of money in the checkbook.
Checks in the mail.
So what does that create? It creates stress, right? And it was funny. Who was the guy that we did this last time?
Evan.
Evan, yeah. I said, what are you going to do, Evan? You don't have no cash and you maxed out your line of credit. He goes, I'm going to be nicer to my wife. So, but here's the whole point. This is very important. And you've got to, you've got to pay attention to how cash is going through your company. And that's why it's very important, and if we have time, I'll throw that worksheet up there, to keep track of your accounts receivable days and your accounts payable days. We can make this game a little bit more complicated and add inventory to it. You know, what's going on with your inventory? You guys, I'll pick on you as a whole, terrible about counting inventory. And it pops out right out of the gate. Because I'll get your balance sheet, and your inventory has been the same for 3 years. And I'm like, how often do you count your inventory? Counting inventory sucks. I don't want to count inventory. You guys can sit down if you want. But then here's what happens. So I make them count the inventory. They say they got $150,000 in inventory, and they finally count it. And guess what? They've only got $50,000 in inventory. So guess where that $100,000 goes? It goes to your cost of goods sold section, and all of a sudden, wham, you get hammered with a $100,000 loss. Because that $100,000 worth of parts done left the train, train station. So I agree counting inventory sucks. Trust me, I had $1 million worth of it. And we counted it every freaking month. But I'll tell you a couple things. One, it's a great way to catch things. So if I had a 55-gallon drum of synthetic gear lube, 75/90, and all of a sudden I'm supposed to have 4 and one way, well shoot, that's a $1,000 drum, right? Who took it? Who'd you sell it to? Because I'll be the first one to admit, I was probably the worst employee of the whole group, because somebody called on Saturday and need something, I'd go running in there and deliver it, and 12 years later, I don't remember what I did on Monday, I don't know, it just happens. So that's the same point. You got parts on the shelf, and you're not ever counting them. What's the chance of one of your employees running up grabbing that part and didn't bill it out because he was in a hurry to finish that truck or something like that?
That
So
doesn't happen.
that can't happen.
No, it does happen.
So even if you don't want to count it all, get some kind of system in place, whether you're counting a third of it monthly, some kind of rolling thing. I mean, a lot of hardware stores will do that. They don't go through and count every nut and bolt every month, but they do have a system in place to check that stuff. But again, your accounts receivable days and payable days are very important. If you're double the size of your company, and you have that negative situation like we had here, you can kind of predict how much of a line of credit you're going to need to do that. It took me a long time to figure this out, and a lot of sleepless nights. Hoping that tomorrow morning there's going to be at least $20,000 in the mailbox when I kind of described it. You think, how many checks did I get? because it's real, and it causes fights between husbands and wives and office managers, and I want to grow the business, and the wife goes, "You're freaking nuts. We ain't got any money now. What are you talking about?" Well, is it because you're not making money, or is it because the faster you grow your company, the faster you're growing your working capital requirement, and you're not taking a look at it?
That was the best lesson I ever learned. I told everybody yesterday, I started my company, I picked up Home Depot, we had 500 trailers. I didn't know what net 90 was. I didn't even ask them when they were going to pay me, Then next thing you know, they were like, yeah, you get paid net 90, So I was like, okay, what's that mean, And they were like, you're going to go 90 days without, before you get the first check.
Yeah.
So I had 10 grand, we used all our kids' savings and everything, I never borrowed money from my mother, but I had like 70 days to go with like $4,000. I gained a lot of market lights.
I'll give you.
I was bad.
I hate to keep bringing up my own company, but it was a perfect example. My accounts receivable days were 27 days, which in general that's pretty good, right? You have to pay for fuel in 10 days. So my overall accounts payable days were 12. So I had a 15-day gap. Well, what I couldn't figure out, and I'm no different than you, it's like, Jesus, I never got any money, and I'm blowing through my line of credit because I'm growing like crazy, and the price of fuel's going up. So if I'm selling $100,000 a day worth of stuff, and I've got a 15-day gap, what do I need? 1.5 million, right? Okay, so why I did this? I'm growing the company, and now I'm selling $200,000 a day of stuff. So now what do I need? Now I need $3 million. At one point, when I sold the company, we was at about $250,000 a day in sales. So if all of a sudden your receivables slow down by 2 days, and my wife worked for me, she was in charge of the payables, we called it the Bank of Tri-County, and she was classic, I gotta bill, I gotta pay it. It's like, goddamn, slow down. So say she starts paying the bills quicker, and that goes to 10 days instead of 12, you've had a 4-day change, that's $1 million. It does nothing to do with the company's profit or, true cash flow, but you just sucked $1 million worth of cash out of that company because your receivables slowed down by 2 days and your payables dropped by 2 days. Now that's a pretty extreme example, but it does bear in mind, pay attention to it, you know, and maybe you don't pay attention to it every month, but you know, in January, if it was this in December, something happened in the middle, it can really affect the money that's in the checkbook. So, clear as mud? Okay, we got an hour. If this makes sense.
I was gonna say something. I would really pay attention to, from the accounting perspective, on how fast and efficient you are, right? So when you're gonna go invoice your customers, the faster you can get that invoice out, like you talked about those days, right? No, it takes us a bit to do it, it takes 2 or 3 days to get our invoice out, those are 3 days.
3 days that
you
you're
just
missing.
burned. That 3 days, how much is it really costing you from a cash flow perspective? It can be material and significant. And so really understanding that, how can I decrease errors and eliminate them, right? Because some people will just sit, this is wrong, they're more sophisticated, they're a bigger company, they know it's wrong and they sit on it, waiting for you to tell them, right? How to be efficient and accurate. And
What was your
be
margin,
fast.
your average margin?
Sucked.
Yeah, because oil and SB.
Yeah, I mean, so that's a loaded question, and we got an hour, so if you don't mind me telling stories, I'll tell you another story.
Yep.
I had a banker, I got a new banker, so this goes down, I had one bank, and I liked having one bank, you know, they know all your stuff, and they was pretty good to work with. They got a new credit manager. Yeah. So I thought new head of underwriting. And it was with Associated Bank, so they're a pretty big bank based out of Green Bay. They wanted me to come meet the new underwriting guy. I'm like, all right. So this was my loan officer said this. So I'm going to the bank, and I'm assuming that I'm just going for a meet and greet, right? I walk into the conference room, and it's like, uh-oh. There's piles of papers, all my stuff. And the loan officer's sitting here, and his boss is sitting there, and the new credit guy is sitting across the table from me. And he starts pounding his finger on my desk. This is a true story. He goes, your margins are going down, and sooner or later these are going to be negative numbers, and I want to know what you're doing about it. And I'm looking at him going, uh-oh, this guy don't get it. So you asked about margins. If I make 20 cents a gallon, and fuel's $1 a gallon, it's 20%, right? If fuel goes up to $2 a gallon, I'm still making 20 cents a gallon. Now I'm making a 10% margin. So my margins depended greatly on what the cost of fuel is. So what we tracked was cents per gallon. So how many cents per gallon was I making on the fuel? So on my financial statements, in that income trend that I was talking to you about, at the top, I had how many gallons of fuel I sold and how many gallons of oil I sold. So one of the key performance indicators, KPIs, that I kept track of on that ratio analysis sheet on a monthly basis is how many cents per gallon was I making on the fuel that I sold and how many cents per gallon was I making on the lubricants that we sold. So I didn't pay attention to margins. Okay. For you guys, I think a very important metric would be what's your billable hours versus, you know, what hours are you paying the employee and how many hours are you billing them? You know, I understand you bill by book time, and I've worked with a lot of service type industries like this. I got a fire truck company I work with right now. He's at 125%. But he's back to, you go back to the Switzerland structure, he sells E1 fire trucks. If you buy an E1 fire truck, guess where you're going to go get serviced? More than likely, you're going to go to the E1 dealership. So he doesn't have that competition, you know, on how he's going to bill the hours. But it's also painful though when I'm working with a service and they're billing 80% of their hours, you know, they're only billing out 80% of what they're paying. It's a huge hole. You guys was talking about the property management company that we owned. We had maintenance techs. Same problem there. You know, we was only billing out 80% of what we was paying them. So that's where you really, and it's what I like about, develop that ratio analysis page and develop some key KPIs that you're looking at on a regular basis, because, you know, you could have the same amount of techs working for you, and all of a sudden, you know, maybe you have an inefficient way, like Steve said, of doing your billing. You know, is he taking a long time to bill that job out? You know, and you're not, and he's not adding that to the ticket, or you can't add it to the ticket because of competition reasons, stuff like that. It all makes sense. Dang, something else popped into my head I was gonna make sure I brought up. Oh, lines of credit. So, have you guys ever heard of an asset-based line of credit or a borrowing-based certificate? If you get to the point, this kind of goes back to if you're factoring and you want to quit factoring. When I was growing my company, I was given a line of credit. Well, I'm growing, price of fuel's going up. I mean, we're blowing through our line of credit every day. And it's just painful, you know, increase at 400,000, still blowing through it, you know, because the company kept growing. My banker's name was Steve, and Steve told me one time, he goes, Terry, I used to go home and think about my wife, my kids, my future, and now I go home and I think about your account. Because one day he got a phone call from Green Bay. It was, you know, get into farming season. We go through 1 million gallons of fuel in a week. And yeah, I was overdrawn by like $700,000. And he didn't bounce the check, you know, but I had it back in there the next day. But that's how quick money can flow around. But what kind of angered me is finally, and I didn't know, that's why I love the book, You Don't Know What You Don't Know, you can get set up on a borrowing-based certificate. So what that means is there's really no upper end to your line of credit. Your line of credit is based off of, usually it's 70 to 80% of your accounts receivable that's less than 90 days old, and typically 50% of your inventory that's good. So as long as, you know, let's say you have $1 million in accounts receivable, so let's just say 75%, then you have $75,000 that theoretically you can have out there because of your receivable, and let's just say again you had $1 million worth of inventory. I know you don't, but then you can have $500,000 because of your inventory needs. So that in total is what, $1,250,000? So as long as you, at the end of the month, then you fill out a borrowing-based certificate, which basically says my accounts receivable under 60 days is X times 75% is your 75,000. My inventory, non-obsolete inventory, is this times 50%. Is that equals $1,250,000. Subtract, I got $1 million pulled on my line. You know, you're to the good by 250. So that was another. Sorry, I don't mean to point at you again. That was another KPI that we tracked. What's the percent? What percentage of my line do I have used up? And it was never really a problem until fuel got $4 a gallon, and I bet you in 10 years I didn't lose $50,000 in bad debt, and I had $500,000 go south in less than a month. So that sucks. Okay, this is an actual valuation that I did on a company. So I just want to kind of run you through it, and this is the real deal. It's not on a PowerPoint, it's on a PDF, so I'm going to have to kind of sit them back here. Do you like the name of the company? We fix it.
Do you want me to drive for you?
Huh?
Do you want me to drive for you?
Yeah, if you want to. So, I'm not selling you something here, I'm just telling you how things could be done. We do, this is what we call a summary valuation. It doesn't 100% meet NACVA's. NACVA is the National Association of Certified Valuation Analysts. It doesn't meet 100% of the requirements. What it does not have in it, let me back up. There's a lot more documentation in a NACVA thing. You got a complete write-up on the company, the management team, the industry, all the add-backs and stuff we do, you explain in detail why you did all of them. And it's a lot more money. This is a summary valuation. It doesn't have a whole lot of write-up to it, but you get the same number with both of them. And most of the time, if I'm doing a valuation for a business owner, he doesn't need to know the history of the company. He doesn't need to know, you know, the write-up on the management or the industry you're living in, right? So this is a summary valuation that we do. You're going to have your, you know, your income trends and your bankability. We'll show you the bankability method, so you can go to the next page. This was the letter that we put on there, that we valued 100% of the company for $1,600,000. This was actually an out-of-body shop that we did. Okay. Simple introduction, just talks about the fair market value, gets into the three approaches. We have valued the company as a going concern. Did you see that up there? So that means, this one was working great earlier. It's not showing up on there now. But right here, so a going concern, that's the evaluator world, that's kind of the deal. That means this is a going concern. This is an ongoing business. Okay? We talked about the income approach. We used a weighted average of several historical periods. And it explains the market approach, which we talked about earlier. You know, you're just looking at different companies, and I'm pretty sure we'll have an element of the market approach in here. I'll show you. And then the asset approach is basically, you know, the company's not making any money. So in this valuation, we used the income approach. So we looked at 15, 16, 17, 18's financial statements. We annualized them. So if it's July or September, we'll, you know, divide it by 7 times 12 and come up with an annualized number. So we're looking at 3.6 in income, 3.8, 4 million. Top line revenues, fairly stable. Gross profit, more importantly, right? 1.6, just about 1.7, 1.7, 1.8, 1,877,000. So that's all pretty stable. Margins look pretty stable, right at 46%, 47%. Okay.
You wouldn't put your labor up in the top there? Plus the goods sold?
Yes. So this is something, when you're doing evaluation, that starts to come out. People get very complacent with their CPAs. And, I mean, you get these and it's like, ugh. I mean, I've seen stuff where here they'll have number 23, or up on the income side, you know, 23, 24. Oh, what's 23 and 24? It's like, oh, that was the sales of groceries, and the other one was the sales of this. It's like, well, I didn't know that, you know. So if you're going to sell your company, your financial statements are the face of your company. Right. And people get complacent with them, and oftentimes, sometimes you just, you know, it's like seeing the forest from the tree. So yes, I've got trucking companies that have one line item in their cost of goods sold section. Drive you crazy. So go ahead and spin down to the bottom. All those expenses. Another thing about expenses, your income statement shouldn't be longer than 3 or 4 pages. I'll get an income statement that's 10 pages long. You can't analyze an income statement that's 10 pages long. You know, consolidate it. Okay, keep going, get to the bottom. So here we got, keep going. Net, so let's talk about, okay. So we had a net income of 355, 392, 264, 459, but more importantly, the seller's discretionary income pretty stable. So we ended up averaging the last 3 years. So this is something, it's another evaluator's judgment call, you know. But if you're looking at buying another company or even with yours, so you really want to look at that trend. Is the trend going up? You know, then you can actually do what's called this kind of future cash flow method, where you're valuing the future cash flows of the company. You know, is the company going down? I see a lot of situations where the owner retired 3 years ago, but he didn't sell the company yet. So, you know, I call it the glider effect. So if you're looking at buying a company and he had seller's discretionary earnings of 600,000 and 500,000 and 400,000, well, what do you think next year's going to be? You know, or do you have, like this case, we're pretty stable, so we just used this average for the evaluation. Okay, go to the next page. So I thought, I must have 2 of these. I got another one where I value, go back to the ad actually for a second, see. So this is where, say you was wanting to buy a company, and we talked about the hub and spoke, right? So, and you know that the owner of the company does everything. But you already have another shop, and you're not gonna go there and do all that work. So in this add back section, you may wanna put a line item in there, 2 new techs, and subtract from the cash flow, you know, 80,000, whatever you're gonna have to pay those techs. Or you know that you're gonna have to pay a higher rent or something like that. If I'm valuing the business for you, I'll put that into my valuation. It's relevant. I've had 2 situations where it's important who's paying me. The buyer was paying me. And the one was a dental company. I valued it at $800,000. No, I valued it at $2.4 million. And the buyers bought it for $800,000. So this is kind of another point to drive home with these acquisitions. If the other person doesn't know what they're doing, I mean, you run into a lot of situations where they want too much, but you run into other situations where and he was tickled pink to get $800,000 because he was just going to walk away from it and lock the door. So I had another excavating company. This is kind of an interesting situation too, where you had 3 owners. The old man, who's now 75, none of this, and then two young guys that came into the company 5 years previously, no relation. But when they came into the company wasn't making any money. And these 2 guys were like rock stars, and 5 years later it's making an immense amount of money. Well, they paid me for the valuation because what they was upset about is they're the ones that grew the company, and now they're gonna have to pay him for the value of that cash flow that they created. So I valued the company at $15 million and ended up buying it at 8. So kind of another situation. Interesting. So we use 3 years here. So I think if we go to the next page, we got start looking at the bankability of it. We'll put an estimated selling price of $1.6 million. If you paid yourself $100,000, you put 20% down. That's $320. You end up with a loan of $1,280,000, 6% interest. 5-year amortization schedule gives you debt service coverage debt service of $296,000. And if we go down a little bit lower, gives you a debt service coverage ratio of 1.68. So we're at 1.7. So pretty decent. And then you're paying it off at 31. Your cap rate's at 31%. So a little quicker than 3 years. So okay, next page. So here I think it's just showed purchase price of $1 million. Same kind of scenario. If we go down and look at the debt service coverage ratio, 2.68. So now we're way up there. Okay, keep going. Then we did 2.4, kind of like showing on each side, $100,000, blah, blah, blah. You know, now we're at 1.1. Yeah, that don't pass. So keep going. Can you turn that? I think if you click on view at the top and then rotate. So this is this is where I can go. It's showing a pay. So if I want to say, well, how do I know what a fair market value rate is for somebody's salary? I can go to U.S. Bureau of Labor Statistics, and it'll show you, where you get information. So in this one, top executive said an annual mean wage of 128. We ended up using 100,000 in the valuation. So on the next page, I'm gonna flip this again. So this is a company called Business Reference Guide, and they're the ones that purchase what's called rule of thumb data. So for this NAICS code, auto parts and accessories, they're saying if you go a little bit further, rule of thumb is annual sales, 40% of annual sales plus inventory. For this particular one, they didn't give me very much. Most of the time, depending on the industry, they might give you 3 or 4 different ways to look at it. Okay, and this is good data. I include this in the thing. I think there's a whole report in there. Might be keep going down. Yeah, It gives you some benchmark data, some percentages that, you know, you can compare to the company. Some tips on buying it, a little bit of industry information.
That 40% of sales, that's a pricing guide that's selling the business?
Yeah, so that's rule of thumb. So what this company does, Business Reference Guide, is people like us report sales of companies to them, and then they, you know, do you understand what an NAICS code is? Ever heard of that? Did I do that? Every company has an NAICS code. Whether you're a barber shop, a trucking company, a service business, and if you look on your taxes, that'll be on there. They call it a business use code, I believe. Is that right? So we report sales to this company, and they say, okay, that was in this NAICS code, and then they come up with this rule of thumb data. If you went to our website, you can take a valuation using Biz Equity. Then there's companies that will take this and make an algorithm, and you give them information, and they'll tell you the value of your company. I don't like that because it's just. I had one this week that Biz Equity said the company was worth $308,000, and after looking at it a little more closely, it's like $125. So I don't believe it as much. Next page. We'll just keep going until I think there's a summary here. Okay, this is. Let me turn this one in real quick. This is another company that I can go to called Key Value Data, and what they'll do is, again, so those auto parts, it's giving you sellers a multiple of sellers' discretionary income is what I look on this one. It's saying a way to value that company from a market value perspective is 2.66 times sellers' discretionary earnings. So keep going. There's just another one. This 2.75, 1.3, 2.7. Okay, so here's what I do then at kind of the end of the report. Come back down a little bit. Well, I think you can go down a little bit further, or up a little bit, I'm sorry.
Oh, let me make it a little smaller so it's easier to see.
Okay, so from a bankability standpoint, I like $1.6 million. That's what I'm valuing this company at. The company had an average sales in 17 and 18 of $4 million, sellers discretionary earnings of $598, $498,000 in EBITDA, $785,000 in inventory. So I'm saying the company's worth $1.6 million. What I'm trying to do is, it's called a sanity check. Does that number make sense? So if rule of thumb says 40% of sales plus inventory, then that number comes out to 2.3. Higher than my number, but remember in the bankability we put the 2.4 million in there and you only get a debt service coverage ratio of 1.1. That's why I didn't like that number. In the biz comps data, it said sellers discretionary earnings, we had a range of 1.3 to 2.75. So at 1.3, that gives you a purchase price of 784, 2.75, 1.6. So that one hits kind of on target. 3 to 4 times the EBITDA gives you a range of 1.5 to 2 million. So my 1.6 is pretty much, I think, in the middle. I put these in the valuation report because to kind of show an owner what they're going to get. It was kind of funny. I did a presentation in St. Louis at the Renaissance Hotel by the airport, and got done. And a guy comes up to me, older gentleman, and he goes, "You ain't talking about that multiple EBITDA. I'm telling you right now, I might as well just lock my doors and collect my accounts receivable and sell my inventory because it's a heck of a lot higher than you're going to get some multiple of EBITDA." They said, "So wait a minute. And remember we talked about the valuation teeter-totter? You know, you're going to get one check that is a multiple of EBITDA, one check for the company, and then theoretically another check. You know, you're going to keep your cash. You are going to collect it's going to pay you cost for good inventory, and you're going to collect your accounts receivable." And he looked at me and he goes, "Are you sure?" I'm like, "Yes, I'm sure." So I ended up valuing this company. I valued this company for $26 million, and he had $25 million in cash, inventory, and accounts receivable. So at the end of the day, he's going to walk away with close to $50 million. So what are you going to get from the sale of this business? The real estate we're saying was worth around $350,000. You see, the sale of the business 1.6 million, he's got $81,000 in cash, $355,000 in accounts receivable, and almost $800,000 in inventory. So you're looking at collecting about $3.1 million. So now, you know, if you're buying a company, that's great. That's what you need to prepare for, and you know, it kind of gives you a working capital requirement. Is if you're selling your company, this is where you need to go talk to your financial advisor. On the surface, that's a big tax hit. So I'm a big advocate of building your team. So go talk to your financial advisor, and what can him and your CPA do to help you minimize your tax liability when you're selling that company. In the book, I talk about things I did right, things I didn't do right. I didn't do this right. I kept it quiet. I didn't tell my CPA because he was also a big farmer, a big customer, so I didn't want him to know about it. I didn't seek out the advice of a financial advisor because I just didn't know. I wrote a big check to Uncle Sam. It's very important. I mean, gosh, that drilling company I was talking about, we did a deferred compensation program with them and literally saved them over $100,000 in taxes. Just the way we was able to rig that sale. You know, with me, so there's risk in doing owner financing and waiting for money in the future and stuff like that. But, you know, I sold my company to a $6 billion corporation. They ain't going anywhere. I should have stretched that baby out as long as possible, you know. So I always say, you know, use a business order when you sell your business. What do you want? You want a check, right? You want that big fat check. Yeah, we all want that, but you know, it comes with a big fat tax liability. So this is really the nuts and bolts of it. That's the process I go through. This is generally what we're giving a company. How I do the valuation can matter depending on who's paying for it. But that gives you a pretty good idea of what your company's worth. And in my opinion, everybody should have their company valued, whether you plan on selling in 10 years or you plan on selling pretty quick. You need to know the value of your company so you can plan. You know, who's on your team, who's your banker, who's your attorney, who's your financial advisor. You're going to need a different financial advisor if you've got $80,000 worth of investable assets versus, you know, a couple of million. It's different people. Know about that and know your exit plan. How am I getting out of this thing and what's it going to cost me? The saddest thing I see is when people come to me and they think their company's worth $10 million and it's only worth $5 million, and that's before Uncle Sam's spark. And what's even more sad about that, we talk about getting complacent on your financial statements and stuff like that. Financial advisors can be guilty of it too. I run into a lot of financial advisors where the owner is going to the financial advisor and telling him, my company's worth $10 million. So what's he do? He writes up a retirement plan as if we're magically going to get that $10 million check one day. And then you're 65 years old and you come seek out one of us and we value the company and say, it's only worth $5 million and that's before Uncle Sam. And you go, oh shit, you know, now I got to work another 10 years. I tell a story in the book. I had a couple came to me, older, I want to sell the company this year, I could sell it tomorrow, that'd be better. And when he called me, he said, I don't need a broker, but I would like your opinion. So I said, well, bring me, a couple years of financial statements. And he brings me 3 years worth of tax returns, flops them on the desk, and I'm supposed to give him an answer just like that. And I looked through them, asked about ad backs, do you have any ad backs? Nope. Mom does the books, they're squeaky clean. I'm like, all right. So I'm like, I don't know, this thing's probably worth $250,000. And he looks up at the ceiling, and she looks out the window, and I'm like, that wasn't the number, that wasn't what they wanted to hear. Then all of a sudden I can see she's got a tear rolling down her face, and I'm like, okay, time out. That's not the number you wanted to hear. What was you thinking? What's going on? And he said, well, our sales are 1.2, 1.3 million. He said, I thought it was easily worth over $1 million. It's like, no. And then Mom pipes up, and she says, our credit card bill is $5,000 a month, and that's all gas, groceries, personal items. I'm like, all right, well, that's $60,000 a year. We can add that into it. So, we talked further and a couple of other things, and maybe at the end of the day, the thing was worth $400,000 or $500,000, but it sure as heck wasn't worth $1 million. So I blew their retirement plans in one afternoon. So.
Terry, a question. What are the events that you would cause to have another reevaluation done? So if I'm in a younger place and I've got 40 years to go, could you give me advice as to when an evaluation should be done based on moves that I'm going to make right and have
You can make an argument that you should do it every year. And really, it's not hard with the information that I give you. So, go back to where we got that cap rate. Anybody got a calculator on? A little bit, no, one of the bankability methods of the 1.6 million. So, Steve, what I would tell you is, it's easy for me to say it's easy to get to the true cash flow of your company, right? But I do it every day. But I can teach you, or you can teach yourself really easy. We're only talking about really adding back depreciation, and stuff like that to get to a good cash flow number. This 20.78%, divide the cash flow by 20.78, like we showed you, and you should come up with whatever I'm saying, whatever I'm saying the value of the company is. This was the 2.41. So if you divide 0.20, what was it, by the cash flow of 498, you should get the 2.41, right? 20, what was that number down there, Steve?
Which one?
2078. So 0.2078 divided by 498, 815. Whoa. 498, 815 divided by 0.2078. Yeah. So that gave me a 2.4. So divide cash flow by that. So if I did a valuation for you, and I say the company, your discount rate, cap rate, kind of capitalization rate, that's what cap means, is 0.2078, and you know how to get the cash flow of your company. If your cash flow goes up, that's going to get you back to your number. But other things that would trigger needing, maybe a more formal, updated evaluation is, are you going through financial planning? Are you looking at buying another company? If you're a bank, banks will say, well, we're cash flow lenders. If they're truly a cash flow lender, then this may be a good thing to put in front of them, or at least give them an idea. For SBA valuations, if you're going to do an SBA loan and there's over $250,000 of goodwill in the company, they require a business valuation. So we do a lot of SBA valuations. So does that kind of answer your question? If you, Steve will agree with me on this, we see, different types of sales. So, I think you're going to talk a little bit about tomorrow, aren't you, Steve, on transition. So I don't want to steal your thunder, but for the sake that you're in this room, one thing I would tell you, if you're going to transfer, if you know you're going to sell your company to your son, or let's say a sibling, I'm sorry, son, daughter, doesn't matter, or a key employee, make sure you're setting them up that they got the wherewithal to borrow the money to buy the company. Gosh, I got 2 or 3 situations going on right now where the son wants to buy the company, but and he's worked in the company for a long time, but mom and dad was only ever paying him a living wage. So if the company's worth $1.6 million and SBA requires 10% down, he ain't got the $160,000 to put down on it. And mom and dad need the money from selling the company to retire. Steve will get into a whole bunch of other stuff. That's like a whole other topic, right? But just, we're basically wrapping up unless you guys got other questions. But, if I had to leave you with one thing, prepare, build your team, know what the thing's worth. When you go to sell your company, don't go to your estate planning attorney. Find an attorney that does mergers and acquisitions. That's a pretty good thing, wouldn't you say?
Yeah, I mean, the CPAs and the attorneys that you have, typically the general business, strategic advisors, if they don't have experience with what he's talking about, mergers and acquisitions, buying and selling companies, the problem is you're gonna get bad advice. And I'll give you an example. We had a company up in Denver that we were selling like 13 months with this business owner. It was a $3.8 million sale of his business, phenomenal price. Now, this is the best price this guy will ever get. He talks 2 weeks before we're fixing to literally close, purchase agreement, sign and sell it. Talks to his attorney and CPA, neither of which had any experience in this, and said that that price was really low. Right, because remember, his revenue was higher, so they're thinking, well, you should be worth $5 million or $6 million, right? Well, no, I mean, when you go through the whole process, and so the whole deal unraveled. And what's sad is that will be the best price this guy will ever get.
Yeah.
He got a max price on the sale, we had 3 buyers, got up to that. And so it's sad, I mean, it was 3 years ago, we learned a lot at that point. Immediately, we had to get the who are the advisors that the business owner is listening to, and to start even coaching them potentially, because it can get derailed, and your sale can get derailed, and you don't even know that you screwed up.
This report is also very effective if you're wanting to buy a company. You know, and make sure you don't overpay for it. You know, I mean, I've seen same situations where, so we're doing this one at the 2.4 and it doesn't cash flow, right? We only got debt service coverage ratio of 1.1. In one case, it was a meat market. Dad sold the kids to the business, you know, I think the exact numbers, but the cash flow didn't work. And for 5 or 6 years, the kids were just, you know, it wasn't working. That's stressful, it's miserable. And finally, they had to go in and redo it. I mean, you know, if you're looking at a $2 million purchase price, we do this for about $2,500. That's pretty dang cheap to make sure you're making the right decision, you know. So then you can also use this. So like in Steve's situation or others, this is a good tool, negotiating tool, if the owner's way too high on their price. You know, I would love to do a whole nother class on kind of strategies behind acquisitions. And Steve and I was talking on break, because I think the next time what I want to do is go a little bit further with that financial statement and show you guys, you know, go through the little exercise that we did and say, you know, we can scratch this expense, this expense, this expense, and this expense off, which is going to raise the cash flow to say $400,000, which theoretically, by our little bankability thing here, raises the price from 1.6 to 2.4, but we're going to negotiate to buy to 1.6. But keep in your mind that about 2.4 to you. So when you go through this process of buying a company and all this little shit starts popping up, you know, $10,000 here or there, you know, it can kind of play as a, just shut up and get it done. Right? Because it's a good deal.
Now, one thing I'll say, I'm not saying, hey, you know, use an advisor, but I mean, I built my first company. It was a national recruiting consulting firm. We had huge clients around the world and country, and I have no clue, like I'm selling a business, this was like 12, 15 years ago, to go get a broker. I can guarantee I lost $2-3 million on selling my company. Didn't even know. Literally didn't even know. Because the contracts that we actually had with global and national agreements with Fortune 500 companies, for what I did, it took an extraordinary amount of time to get those. They were worth huge money. And bigger companies would pay for them because they couldn't get them. We didn't know.
Yeah.
Sold it for a significant amount less. We had no idea. We thought we got a good deal, thinking, hey, this is a smart way to do this. And had
Yeah, it does. It makes a difference. So it's all about building your team. So, well, thank you. Look, any questions? I mean, ask anything. You guys were kind of quiet today. Must be early. Did you stay out too late last night? I was a good boy.
Even if this wasn't just buying a company, you should be doing this just to know where you're setting if we're buying big equipment as well, to a point.
Yeah, to a point. I mean, it's just a.
So when you do evaluations, I mean, that's what I'm saying. So you're teaching us how to know our checks and balances.
Mm-hmm. Yeah.
Sometimes owners don't, you know,
No, they don't. And, you know, and it's so funny because I'm the living proof of all this. I mean, I didn't know this crap when I was, when I first started in the oil business. I didn't know why I was getting turned down by banks. When I went through a couple of these classes, I mean, when I'm blowing through my line of credit by hundreds of thousands of dollars, let me tell you, there's a reason I got a bald spot there. And somebody taught me that for the first time. I almost went up through my room and wept because I just finally figured out what in the hell was going on with my company, And then that was kind of the journey. It's like, wow, well, now I know what I'm doing. Now I know why this. And, I mean, here's another flash of news. Your banker ain't the smartest tack in the drawer, let me tell you. I bet you 50% of the bankers out there don't know anything about how to come up with accounts receivable days, payable days. I mean, when I first started working at Regions Bank, Regions is a big bank, and they had a big powwow. They had the trainer guy in, and we're talking about accounts receivable days, payable days, and I'm like, what the heck? This is like kindergarten stuff, I would think, for a banker. So the first break, I go up to the guy in front of the class, and I said, are you going to talk about, if I know your receivable days and accounts payable days and stuff like that in your daily sales, remember we just did the routine here. I said, they should be able to figure out what they need for a line of credit pretty easy. And the trainer looked at me and goes, if I tried to explain that to them, it would blow their mind. So, and that's what can be very frustrating. Just like with the line of credit with me, they've just given me a line of credit. And then they finally put me on a borrowing-based certificate. Oh, thank God. That was the last time I ever had to argue about what I needed for a line of credit. As long as I'm in that range, I'm good. And then what did we do? We kept track of it and tracked it, in our ratios on a monthly basis. So that's the key, and like I said, this stuff really, it's not rocket science. I mean, if I can figure it out, trust me. So, yeah, fun stuff. But feel free to pick up a copy of the book. It's a quick read. At the end of each chapter, that was kind of my aha moment. I used a book coach to write it. I'm going to tell you, it's a painful ordeal to go through. I'm a finance guy, not a writer. But I got to the end, and the last thing I did is at the end of each chapter, there's questions. We call it discussion points. So that was kind of the aha moment, because believe me, you're going through, and I know it's not a very big book, but it's like, Jesus, as soon as if you're going to read this dumb thing, But when I wrote those questions, that's when it was like, you know what? If you read this book, and you can answer these questions, you'll have learned something. So it's a get good reviews on it. So I mean, you'll get something out of it. So
I find that most companies, like, at the end of the year, they have a profit of $200,000. Do they usually keep that in the companies, or do they take that out, or what are they doing for their cash? They don't use that for cash flow.
Okay, so here's what I would tell you: if you're keeping track of those key ratios, one thing we haven't talked about here today is current ratio. So current ratio is how many current assets do you have compared to your current liabilities, and that's what's going to tell you. What's going to tell a banker how can you weather the storm? So if all of a sudden, crap, nobody's coming in the shop, what do I have to pay my bills? If you're 1-to-1, or worse yet, upside down, because so if you guys factor your receivables, you're getting your money today, and you're spending it to pay bills. Companies that factor receivables are really susceptible to having more accounts payable, more current liabilities than they do current assets. So I would say you're upside down there. I would like that number to be at least 2 times current assets to your current liabilities. So if your current liability, so your current ratio is in good shape. The working capital that you need for your company with your accounts receivable, and you've got 2 times or 1.5 times that you need of that. So what I'm telling you is, if your debt service coverage ratio is good, you're above a 2, so you're meeting those requirements good, then that's where you flip it around and do everything you can not to show as much, take the money out of the company, or do whatever you can to reduce your tax liabilities. If you're not at a very bankable number with your debt service coverage ratio and stuff like that, quit taking the money out of the business. Keep yourself bankable. I mean, I like that word bankability.
Can you talk about, because we get this all the time too, the owner's really proud because they've hardly paid any taxes. And what happens is, a lot of times the value of your business truncates significantly as well because your net profits are really low. Can you talk a little bit about that?
Yeah, so when you go to sell your business, you want that sucker to look like a shiny new dime. And I mean, what have we looked at with the companies today as far as their cash flow the last 3 to 5 years? Paying taxes suck. But if you want to sell your company, make those last 3 years, do everything you can to drive value to that bottom line. That is the cornerstone of what your company's being sold on. You know, this stuff is very important and it will affect the value of your company or if it's even sellable. But the main emphasis is going to be what kind of cash flow is that thing spinning out. So, yeah, I mean, you do get that all the time. Like, oh, I showed Uncle Sam the last 5 years I ain't made a nickel. Well, congratulations, your company ain't more than a nickel either. You know, so it's true. You know, farmers are especially guilty of it. But so to answer your question, if your company is in great financial shape and you don't plan on selling for the next 5 years, absolutely, take every nickel you can out of it. That's what the heck you got it for, you know? Same way with those ad backs. God, that trucking company I was telling you about, one owner, he has a racing habit. Ugh. You know, so he's getting into drag racing. You got a racing habit? So here's what he did though. He started a drag racing team. And he already owns a trucking company. So he has truck expenses already on his balance or income statement, right? Well, his ad backs were literally as long as the freaking operating expenses. Well, you know, we got to throw in, you know, had to buy all new tools on the trailer, had to buy the trailer, had to fix the trailer up, had to put tires on the trailer. I got fuel for running from race to race. You know, all that crap he's trying to add back. It's like his financial statements were already 10 pages long. It was a freaking disaster, you know. There's nothing wrong with racing, but if you're going to run through your company, put some specific line items on there so that when you go to do that add back, it's like, this is all to the racing, and here's the invoices to back it up. That's a solid add back. This squishy stuff of, you know, well, $10,000 and this and $5,000 and that. The buyer's going to look at that and go, yeah, BS. So that's the whole thing. I mean, just keep everything clean. It really is. I mean, when I sold my company, from the day we signed the letter of intent to the closing day, 6 weeks. And that's phenomenal. I mean, that's just, they were sophisticated buyers, obviously. I mean, they got their own acquisition department. And I knew what I was doing just because I'd done it. You know, if you have leases, if you have your trucks, your equipment, have, you know, those major assets, have a 3-ring binder with what it is, where you got it, what you paid for it, how'd you service it, because those are due diligence questions that people aren't done. And the faster you can make that process go, the easier it is going to sell your company. I mean, I would tell you the #1 killer for selling a company is an overly priced company, but probably a close second is time. I mean, the longer it takes, it's just another reason for something to happen.
Time fills all the.
Yeah, so flip that around also in buying a company. You know, if you want to buy a company, you identify it, and you come up with a price. I mean, I can turn you on to a good attorney. We'll get this thing done lickety split. You know, but if you give that owner time to think about it, and then they talk to somebody in the bar, and then they, you know, somebody told them this, and so it's all about the planning. You know, same way if you are thinking about acquiring another company or purchasing another piece of equipment. Another thing that I did on an annual basis is that I went and talked to my banker. You know, and after the deal with Associated Bank and, you know, that pound, I left them. It took 6 months to do it because I had a ton of real estate and stuff like that. But when I left, the 2 loan officers were like, hey, I thought we had that patched up. It's like, you lost my business the day he was pounding his finger on the desk. I mean, we was done. And I did go to 2 banks then. So I had one bank that held my line of credit and did cash needs, and I had one bank that did my long-term debt. And I had a third bank that I didn't do business with, but I gave them my tax returns and financial statements every year, just in case, we get another knucklehead pounding on the desk, and somebody interested in my business. So talk to your banker on an annual basis and tell them what you're planning on doing and get their feel.
I was gonna say, I had two interesting metrics. This is from the consulting and recruiting side, and we had thousands and thousands of hours charged. And this is on the billable side, because I've heard you guys, billable hours is really important. There's two interesting metrics that we would charge, I think, track, that would be relevant to your industry. So one is called leakage. Are you guys familiar with leakage? So if you look at a specific resource, let's say that like 40 hours a week is your estimated number of hours that you'd like them to be billable, right? So what you do is you take the total number of billable hours you had for the week, is a great way to track it, and divide that by the number of billable employees you have. Whatever that number comes out to be, let's say it's 37 hours, those 3 hours, if you're saying they need to be billable 40, those 3 hours that you lost, even if the following week they worked 43, so you're thinking, well, hey, it was 80, they were gonna work 43 anyway. Those 3 hours that you lost, think about this, top line, those 3 hours go right to the bottom line on your net profits. It is significant. You're talking about going from 3 up here, so they could be 15% higher in your net profits if you can get that leakage under control. You can get them up to 40, up to 40, up to 40. That is massive on the bottom line. When I was a COO for a $25 million consulting firm, and our leakage for every 1% that we improved on our utilization, so you got 40 hours a week times they build 30, so the utilization is 75%. Every percentage point that we went up, it took $500,000 to the bottom line. So that's an interesting metric. The other one, we call this one the payroll ratio, the payroll multiple. And payroll can be contractors you work with plus your employees. You take that total amount on your payroll, and it was a very simple calculation. How much cash do we have in the bank, and how many payrolls could be covered from our cash balance? And what we're always wanting to do is improve that. Then I would know, okay, if I paid every bi-weekly, my multiple is 8. That's 16 weeks of payroll I can cover before anything's gonna. If like you said, like sales dip, something happens, economy shifts, I've got that coverage, and we're always wanting to improve that. So it's just interesting little metrics.
I read something about that where Bill Gates had like a year of payroll or whatever in advance set aside for that. Say, are you talking about something like that? We have it, set out for a year, however many weeks you have to set out for.
Hey, that's a very good metric, just like a personal financial advisor would tell you to have, 6 months of your income saved up or something like that. It's another key metric, and you just got to figure out in your business what's important. If you got a high payroll amount, paying your employees is probably a pretty good idea. They get kind of upset when the checks don't go through. It's a good way to lose people. But, yeah. Well, I'll be around. Thanks for your time. If you got any other ideas that you'd like to hear, if you talk to John and we wanted to do a deep dive into financial statements, that could be a whole nother class. We do part of that in our coaching. We call it a profit improvement plan. And we take you through, it's a process of dividing every one of your expenses and income by total sales. And then that gives you a percentage. So we run, you might have seen it, I don't know if it's on this one or not, but then we'll put an income trend together like that. And we pick the best percentage of each year. So this is a division of every one of these line items by total sales. And then, so we could go through this thing and say, well, in this year, this percentage was the best for miscellaneous income. This year, this percentage was the best for bad debt expense. Then you slide those all the way over and you can get what your optimum, what your best percentages were, and then take your budgeted numbers, your budgeted sales, and it'll get you kind of what an optimum income could be for your company. And it's kind of very similar to what Steve was talking about. And then it's really a powerful budgeting tool. It can help you out. So, fun stuff if you like numbers.
We don't have a lot of BS.
Yeah. And, you know, that's another important point. Consolidate them suckers down to where you've got a readable document. So,
Yeah, I love that. It reminds me of golf. I used to be a scratch golfer when I was a kid. And one of the methods that you could do to see what's your best score you could ever shoot, and then what is like your, not worst per se, so you take like 2 balls and you play a best ball. So you hit 2 drives, take your best drive, then drop your 2 balls down, hit your next shot, take your closest, 2 putts, make it, and do that round. And it's kind of like what you're talking about. It's like, what is my optimum scenario? For these expenses, this is when I was being the leanest and the best. It's a really cool way to look at it and strive to be that.
the one Steve, so my partner Steve Denning, got a lot of Steves here. He used to do this all over the United States, and he showed me actual numbers for one, and I mean their average net income was like $248,000, but their optimum net income could be like literally like $700,000. It's eye opening. So
Are you still doing this in-house, or you're not doing it? I remember last time you said that you weren't gonna be taking on any more clients.
I'm not taking on a lot of coaching clients right now. We still want coaching clients. I have somebody else that does it. So we got a couple people that do it actually. So, and they're using the same stuff as me. It's just there's not enough hours in the day. A hub and spoke thing, you know. So, but it's cool stuff. And I mean, if there's any interest in that, I mean, there's no long-term contracts or anything like that. I mean, really, I would say once we've worked a year together, then you kind of need to take a value, you know, take a look back and say, do we need to keep doing this? Do we need to do it, you know, once every 6 months? I mean, I don't want to waste people's money, but you know, but there's a lot more depth to that value builder system in each one of those modules. But then we're always big on you kind of get a 3-for-1, or you know, and then it kind of depends what do you want to work on. You know, is the financial statements a problem? We want to spend more time on that, not the value builder system. That's fine too. But the 3 components would be the value builder system, really working on your financial statements, and you know, do you have the right butts in the seats, and kind of like part of the EOS system, and because it takes a little bit to get it done. So, but it's fun stuff. It's powerful. It's good that you know it. I mean, it's at the end of the day. I mean, to me, it'd be a heck of a lot harder to put a water pump on a truck than it is to do this stuff. I hated working on vehicles. We had junk vehicles, and I was underneath there busting knuckles and everything else. It's like, ugh, you guys can have that. Like, I didn't want the thing to work. Everybody says, I like Ford, I like Dodges. I said, I like a truck that runs. It's not in the shop. I don't care what it is. So, all right, thanks guys. Appreciate it.